Welcome to Business Redefined. This is your weekly, most comprehensive look at the world of business, finance, and economics. A lot has happened in the macro space, notably the fact that the ninth review of the current program with the International Monetary Fund will not be proceeding, and this is according to a statement which came from the fund following conclusion of a mission meeting here in Nairobi. And we want to make sense of all this, and we're joined by Churchill Ogutu, economist at IC Group, not really a guest here, but a regular. Karibu sana.
Thanks a lot for having me.
Churchill, we both had a sense that this was going to happen. The ninth review was not going to be consummated and is a final leg really of the current program. What did you make of the announcement from the IMF? I thought it was very brief and should have had a lot more color around the reasons why it wasn't taking off.
Yeah, thanks. Yes, indeed, it was a brief statement, but it spoke a lot, even in its brevity. And if you look at the context of the ninth review, ideally are things to do with the fiscal targets and also the structural benchmarks. But by all indications on the fiscal targets, the target as of December, that was on the ordinary revenue, we had seen the numbers. Looking at the structural benchmarks that ideally should have been the focus of the ninth review, there were delays, notable delays in meeting some of them, and also some of them have not been met. Yeah. So it was not surprising that the ninth review could not be completed. So that didn't catch us off guard from that perspective. But yes, that was what came out clearly, and it wasn't even unexpected.
Some have argued that perhaps the IMF is pulling the plug belatedly in this sense. If you remember the protracted wait we had for the 7th and 8th review, some people I've spoken to have argued, why didn't they just cancel it at that point? Why did they wait until the ninth review to pull the plug on it?
I think even the context of after the 7th review, which ideally should have ended by June, and it got protracted because the 7th review started in April, before the spring meetings, and 2 weeks later, Ghana, a similar country, which were also having their own reviews, completed even before the spring meetings. So initially the expectations were that probably they'll finish either late April, because spring meetings typically occur in April, or even May at the very latest. But now with June came, and then there was also another shorter statement that came 2 days before the budget statement, if you remember correctly. So at that point, you could see that probably this thing might not materialize, and then it was complicated by the shelving of the finance bill. So to me, I think that the combination of the 7th and 8th review at least was to sort of cushion the fiscus on the back of what happened, the shelving of the finance bill. Because 8th review, ideally, the only things that were there were now on the fiscal targets as of June, because at that point already they had been seen. Structural benchmarks, there wasn't any tweaks, but we all know that even on the structural benchmarks, there were notable delays in meeting the reviews as of the 7th review. So to me, I think it was just one of those signals from the IMF that potentially you could now start reworking on the structural benchmarks. And also remember, those reduced disbursements,
yes, below target.
Exactly, vis-a-vis where we were in the month of January. So those are some of the telltale signs that probably the authorities should have now latched on to be able to ensure that the reform agenda is back on track.
Churchill, a week ago I had a conversation with the senior vice president for Moody's, David Rogovich, mutual friend, and I asked him, so given that the ninth review has technically collapsed, does it follow rather, that the World Bank DPO, which we're also expecting $1 billion in the current financial year, is also on the verge of collapse because of how typically the Bretton Woods, IMF and World Bank tend to work together in terms of disbursements? He's of the view that it doesn't necessarily mean so. I'm curious on your thoughts.
Yeah, I'm aligned with his views, considering that even the last DPO, the World Bank Development Policy Operation, spoke to that was the first of 3 series in a row. And already you could say that the development policy operations are typically disbursed in any given financial year. We've had DPOs since fiscal year June 20, 2018, 2019, thereabout, if I'm not mistaken. So any given fiscal year, there is a development policy operation. But then again, also, remember that we knew that the sunset date of the current program was coming to an end in 1st of April.
Yeah.
So whatever the circumstances, that the DPO was, there were like two successor DPOs after the one that we got last year, already in their minds pretty much indicative that they were sort of detached from the IMF program and also the successor program. So I'm aligned to that. We've seen even other countries on the continent having DPOs, yet they don't have an IMF program, case in point South Africa. So I think, yes, it might be coincidental for the case of Kenya that we have seen DPO coinciding with an IMF program, but it may not be necessarily, that is not necessarily the case. But
Churchill, I think the technicality that individuals like yourself might be overlooking here is that if you look at the conditions attached to DPOs vis-a-vis the conditions attached to the IMF program, they're quite aligned. Kenya Power was cutting across both ends. There were very heavy indications of reforms in the DPO around the Social Health Insurance Fund, then it was NHIF. And I think that's where my suspicion was coming from, that because of the similarity in conditionality, maybe the bank could just be thinking otherwise as well.
Maybe. You can actually be correct. But the way I'm looking at it, probably we may not see that, that there is no DPO this financial year.
Yeah.
Probably a low amount.
Exactly.
What the authorities have indicated is $1 billion, probably a low amount to ensure that now the track agenda, the reforms is still on track as compared to just walking away. Remember with the IMF, this was the final review. And to the previous comment that we saw, the 7th and the 8th review, at least there was some wiggle room to be able to implement some of these structural benchmarks with the delay. But with the 9th review, the program coming to an end by 1st of April, there wasn't any much more wiggle room to be able to extend some of these things. Yeah. But now with the World Bank, probably scope could be lower than what has been preempted disbursements.
Okay.
Yeah.
So now here we are. We have pulled the plug on the 9th review, but simultaneously we are initiating talks for a new program with the fund. What is the metrics that is at play here? Because if you asked me, I would have imagined pull the plug and say whether we are done.
We're done, yeah.
We're done entirely. But here we are pulling the plug but quoting them still that we need you for some hand-holding. Is this a pointer that we are headed to a program which is not accompanied by a disbursement facility to it?
Yeah, that could be a possibility. And for the benefit of our viewers, typically there are a number of IMF financing instruments that are out there. What we were in the program that has now come to an end, the extended credit facility and the extended fund facility, that had a duration of 4 years, and there was some structural benchmarks, so there were some conditions attached to it.
And remember that program was extended, by the way.
Yes, it was extended to the maximum. It can run to a maximum of 4 years. Initially, it was 38 months, and then they extended it for another 10 months. So yeah, the 4 years had a sunset date. We have also other programs that necessarily don't have structural benchmarks, or they don't have any conditions. We're looking at some of the precautionary facilities, standby arrangement, or standby credit facility. So those are what we call insurance covers that we have, but they really don't have conditions attached to it, other than if there could be some adverse balance of payments in the future, the government or the authorities can now be able to tap into that. There are also other IMF lending instruments which don't have what we call exports. Exports is basically the authorities agreeing with IMF that they'll be able to meet these targets, and then the typical reviews happen and to see if at all they met those targets. There are others which take an approach of ex ante. So basically, authorities saying that they would implement ABCD, so to speak, and in the event that, and then they get monies to implement those kind of measures. Morocco has such a program, but it has not tapped into it. So those are some of the options. Finally, we have the policy coordination instrument, which is a non-finance financing from the IMF. So pretty much some technical assistance or some hand-holding from the IMF with no funding. So these are the options that are at place. In my view, and looking at the scope of a funding program, remember that the current program was 5 times our limit.
Yes.
So for a country, we have a limit thresholds from IMF. It's a bit technical, but now the program that came to an end was 5x, 5 times the limit that we have. And then during COVID, we also had an outright disbursement that was around May 2020, so which was 100% our quota. So cumulatively, the facility we got in May 2020 and now the current program should have taken us to 6 times our limit, which is ideally under normal access situation. But right now, we have not received the disbursement with the final review. So that's right about 68% that was still remaining under the main program. So if you look at scope for the size of the program, that is the basis that we have 68%. And then there's the interest payments kick in from this year for the May 2020 and also some of the initial disbursement that we got. So you are seeing that in the next, from 68%, that is what you can now get at the base. And then if you start baking in these interest payments for the next 2 years, you have some scope for potentially getting some two times the size of the program. So that is the basis. But if you work if you work backwards in dollar terms, that's right about $1 billion. So in that scenario, normal access might not be feasible. Can we get into exceptional access where we get more than...
But we just came from that, Churchill.
Yes, now we got from that. We actually had the exceptional access.
Exactly. At the 6th review or 7th?
Yes, to be able to cater for the
Eurobond maturity,
which didn't happen. So we now came lower. We now came back to normal access for ideally for the 9th review. So that's where the 68% is still remaining. So exceptional access, there are also some conditions that needs to be met.
Yes.
So the hurdle, the bar still remains high in terms of meeting exceptional access and also in normal access. We may get some much lower amount. So I think the authorities might be caught torn between getting a low amount, normal access, or a higher amount
under exceptional
access, but the conditions are much more higher. So potentially now it's a long-winded response to your question, but there's scope for either non-funded access, non-funded program, or even a precautionary, which typically don't get into these whole limits that you're talking about.
But actually, here's the problem. If you look at the period between 2026 and 2034, in terms of maturities of Eurobond issuances, there are quite some lumpy maturities coming down.
No doubt.
And that tells you the necessity of not just a funded program, but a reasonably funded program is of priority interest to the government of the day and Kenya for that matter. So don't you think we are literally in a bind here? If you asked me, I don't think the question of an unfunded program is even an option on the table. I think Treasury and other government operatives are literally asking IMF for a funded facility here.
And that's the thing, and this is my view. And also to your question, because you're talking about from 2028 all the way to 2034, at least that's where we get some heavy Eurobond maturities.
Yes.
The scope right now, there's like 68%. The government of Kenya cannot be able to buy time in terms of negotiations. We all read the statement. I didn't get the sense that there's some timelines attached to the statement that they need to finalize by X date or when. But it becomes problematic from 2027 onwards in terms of these external maturities that are coming due. So that is when ideally we should need an IMF program from 2027 there about. 2025, at least we've been able to sort it out. 2026 also is not as scary as from 2027. So from 2027, that is when we ideally need to get a funded program. And by then, we could have gotten much more scope because you started already paying down the debt that we have under the IMF program. So it increases even our wiggle room to be able to get into a normal access, unless now exceptional access terms comes in. But also there, the terms might be quite prohibitive. So 2027, that to me, so they can just buy time for now. And then
that is the year we are all looking forward to.
Exactly.
To flip now our question, Kenya will, in all circumstances, be compelled to become a regular issuer in the international markets because of the maturities we're talking about. And I wonder, if we decided to go to market without an IMF program, how would that look like from a pricing standpoint?
It will be challenging. I've seen other markets, other countries going to IMF program. No, we have seen other countries tapping the international markets without an IMF program. We've seen quite some devastating results. Case in point, Nigeria, late last year, tapping the international markets. It was quite a surprise, but it was coming from a supplementary budget, which now necessitated them to go tap the market. But the pricing was quite adverse. I think there are a number of things that will come into play. One, pretty much people look at the debt distress levels. Kenya being a high, it's deemed to be it's debt. It's high risk of debt distress.
Debt distress, yes.
Exactly, yeah. But then again, you see, this comes from a number. Our debt carrying capacity. As it is, it's a bit technical, but as of the last debt sustainability analysis, we're at around 3.02.
Yeah.
So any number between 2.69 to 3.05 is now deemed to be a medium debt carrying capacity level. Anything above 3.05 is now strong debt carrying capacity levels. So our thresholds right now in terms of debt sustainability is deemed to be medium. That's why you hear things such as present value of debt to be at 55%. But you see, this composite indicator that determines the debt carrying capacity keeps on changing. There are a number of variables to it. Real GDP growth, remittances, imports to imports level of coverage, coverage of imports level. So those are the variables that determine this particular number that now assesses us to be whatever it is, either strong, medium, or low. But if you look at where the outturn over the last couple of months, remittances levels have grown really strongly. Import cover, 5.1 months as it is right now. So it means that probably in the debt sustainability analysis, there could be a likelihood that we could jump from a medium debt carrying capacity to a more strong debt carrying capacity. That probability, and that means that even in terms of how investors assess the risk sentiment might be different as compared to a country that is assessed to be a medium debt carrying capacity country. That is one. And we know that debt sustainability analysis is typically conducted on low income countries. There could also be another possibility that Kenya's growth level becomes bigger and then we jump from a low income country, depending on that assessment, to a middle income country. So countries such as Nigeria that I mentioned earlier they don't have the typical debt sustainability analysis as Kenya. Theirs is different because it's market access countries. So if we flip from a low income country to a middle access country, so even the assessment is different from an investor standpoint. Countries on the continent which are not assessed as Kenya are countries such as Egypt, Nigeria, South Africa. So those are market access countries on the continent, for example. So those kind of things also comes into play besides the IMF program being in place here. So even if they might go to the market, there are a number of variables that investors keep an eye on here.
All right. Churchill, we're left with only 5 minutes and still so much to cover, but let's see how we can dial this down. $1.5 billion from the UAE. Initially, we were told it's a staggered disbursement. Now it looks like it's a bullet disbursement coming to Kenya. To what extent does this change the current topography of the fiscal environment? When I spoke to Rogovich, as I mentioned earlier, he's of the view that in the FY 24-25, the current financial year, even with the loss of the disbursement of the 9th review, we are well covered from a funding side. We have done the buyback on the Eurobond, we've done a buyback domestically, and we're expecting now from the UAE. Do you share that view?
Yes, and it speaks to diversification of sources, because as before this UAE loan came out in the open, we didn't know about it. And in terms of commercial borrowing, we're just looking at tapping the international markets or the syndicated loans market. But as it is right now, the UAE loan coming at around 8.25%, it's more palatable as compared to even going outrightly to get the commercial loans in the international markets here. So it's a good diversification mix. Obviously, the authorities have spoken of other instruments coming into place, samurai bond, panda bonds.
Yes.
So let's see how it
even a
pans out
sukuk has been mentioned.
a number of times here. So it speaks to the diversification that yes, okay, we probably will not get the IMF anchor even going forward, or even the IMF facility itself, but there's a neat diversification that is going on. But to your point, IMF were not impressed some of the comments that came late last year around us now diversifying into other sources.
All right. Churchill, you're parting short, especially around IMF relations, where we are currently. You have seen Supplementary 2 being signed. Some crazy numbers in my view, but I don't know what you think.
Yes, Supplementary 2, it was unexpected because what was tabled was 88 billion, what was assented into law was 113 billion.
It's insane.
And it's pretty much taking us back to the initial budget, because the initial budget was 3.99 trillion. Right now, we are looking at 4 trillion budget, so we're pretty much where we were. But now the difference is the revenues have been lower, recalibrated lower. So
well, expenditure has been bumped up.
Yes. So on the financing of this 113 billion, and you've seen revenues have been lowered significantly. So the borrowing has gone higher significantly, more so the domestic borrowing. Looking at my rough estimates is around over 600 billion in terms of revised domestic borrowing. The good thing is that a number of things are favoring domestic borrowing at this moment. Rates are coming lower. They had already, the outturn is way advanced. So even the months that we are coming into April and May, which ideally we saw some significant maturities, those ones were addressed with the buyback that happened in February. Yeah. So the scope, even going forward, is at least more favorable as compared to a year ago or 2 years ago. So that is not concerning. So I think that is what probably might buy the authorities some space amidst all these spending pressures that we are seeing coming up here.
Churchill Ogutu, always a pleasure. Thank you for your time.
Thank you too.
We have been having a conversation with the economist at IC Group, that's Churchill Ogutu, unpacking the latest development from the IMF program, that is the suspension or termination of the 9th review, as it were, and we are now kicking up progress for a new program with the IMF. We made sense of all this and the options on the table for the country. We wait to see how this pans out. On March 31st, the current program comes to an end. We wait to see any updates coming from the Treasury on that bit, so stay tuned to Business Redefined.